ultimately, diversification is the only free lunch in finance.
Private credit's been the talk of the town in asset management over the last couple of months.
If you have 1 million with them, you're all right, you're not going to be turfed out.
Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Will Robbins, your host for this week. Today on the show, is diversification for wimps? We examine Nick Train's latest claims. Citywire reveals an upside for downbeat private credit investors. And why you now need to be even richer if you want to bank with Coutts. Joining me today are two Citywire journalists, John Schaefer and Victoria Bell, plus Paul Flood, Head of Multi-Asset and Charities at BNY Investments Newton. First story originates from another fund manager to visit our Citywire studio recently, of course, Nick Train. Over the last 25 years, Nick has become a darling of the weekend money pages for a successful buy and hold forever strategy, though performance has been challenged a little bit more recently. But during his conversation with us, he said this.
There's this Buffett idea of diworse-ification, holding too many positions in low conviction investments. It's just a route to mediocrity. It's just a route to index plus or minus a bit.
Viewers, he did not mishear what he said. He did say diversification. I think Nick's little joke, his little play on diversification. But Paul, multi-asset investor, is he wrong?
Well, I don't disagree with some of the sentiment that he's making there, but ultimately diversification is the only free lunch in finance. The point of it is to smooth the client return journey. I agree, adding diversification for diversification's sake doesn't make any sense. But as many viewers and listeners will know, they'll have heard of us say before, multi-asset investing is much more about having the opportunity to invest anywhere, not investing everywhere all the time. It's a bit like being at a fine dining restaurant versus being at a fast food place. In a fine dining restaurant, there's lots of options on the menu. Now, you don't order everything, you order what you think you want to eat at that point in time. Whereas at a fast food restaurant, now there might be lots of choices, but you are eating a burger. There's no doubt about that. And so that's the point of diversification and having the opportunities. And to next point, that was very much our view on the bond market pre-2022. There wasn't any opportunity for returns, there wasn't much opportunity for diversification, so we were very much advocates of moving away from allocations to bonds in a multi-asset context, and that played really well for us in 2022. Now obviously the backdrop has changed and things change over time, and so you're reallocating capital into different areas depending on where we are in the cycle.
I wanted to talk about how you're dealing with the situation we have at the moment, Middle East crisis. Uncertainty seems to be the one thing we can all agree on is characterising this period. And how are you dealing with what's going on at the moment and the fogginess of the outlook from here?
We don't want to react to short-term news flow because ultimately business will adopt and the news flow will change, as we've seen. You know, a month ago everybody was worried and then we had a big market drawdown. As we sit here today, markets are back where they were pre the crisis. The one thing that seems to be clear to me is energy importers are going to want to reduce their reliance on oil and gas in case this situation happens again. And perhaps that leads to more investments in alternative sources of energy production, so renewables, etc. And we've seen the market start to react to that. The second thing that's clear is probably defence in Europe, defence spending needs to go up. Now, even if we found ourselves in a situation where the Middle East conflict resolves itself, so perhaps we find a route through the Ukrainian situation, we are still going to need European governments to invest in defence because it's become clear, and the Trump administration's also been clear about this, that Europe needs to invest in its own defence, and we don't want to rely on outside partners that perhaps at certain times might not have the same interests as we do.
Brilliant. Well, thank you, Paul. And we move on to our next story. And talking of holding investments forever, let's talk about private credit. So the prevailing narrative that's been building over the last few months is that private credit's got a credibility problem. Investors are worried about the loans. Some loans are starting to get their money out. And yet, Citywire now also has some data that shows how funds have actually been performing. So, John, tell us what's going on.
Sure. Well, private credit's been the talk of the town in asset management over the last couple of months, certainly. There's been around 20 billion of redemption requests from private credit funds in the US. These are funds that are targeted at retail investors and the wealth segment. So that's obviously a huge amount of cash. And a lot of the large funds are getting elevated redemption requests and are having to put their gates down. So recently we had a Carlyle fund that had to restrict redemptions, and a similar KKR fund had to do the same. However, it might not all be doom and gloom, I think it's fair to say. We had a conversation with the fund review, and basically they were saying, if you dig into the data a little bit, the performance isn't that bad. The vast majority of these funds are sort of recording positive performance, especially we looked at the February data. They were saying over 60% of the funds were in positive territory of the ones that they track, and of the ones that were in negative territory, only a handful were down by more than 1%. So it seems sort of on top line basis that maybe it's not so bad, maybe it's not all doom and gloom. But look, maybe I'll bring it to you, Paul. I mean, you're an income investor as well as a multi-asset investor. You've historically invested in some alternative income areas in the market. What are your thoughts? Are you sort of similar to sort of Jamie Dimon at JP Morgan, who thinks it's sort of all cockroaches and it's all negative?
Well, I don't think he says it's all cockroaches. His most recent comments were, well, there are problems, but he's not worried about it. So look, what is private credit? Well, it's the same as public credit, but without the liquidity. This is locked up capital. 80% of it is institutional. Are some of the marks wrong? Possibly, we don't know. We don't get to see them. The indications are clearly from a sentiment standpoint, people want their money back because they're worried about some of the lending that's gone on to software companies and whether those software companies will exist once AI starts to disrupt some of those business models. So we don't hold those private assets in our daily liquid funds. And then the second question is, coming back to the wealth management community, what is your client's investment horizon? Because if you hold to maturity, the question is not the mark to market, the question is, do you get your money back? And I think that's what people are probably misallocating. That's what we're seeing with the BDCs, which is an indication of what's going on in private markets. So if you look at NAVs haven't moved very much, the net asset value of the loans. But if you look at the price to net asset value in the BDC market, it's about a 10 to 15% discount to net asset value, which gives you an indication. And so a lot of people talk about private markets and it's a smooth volatility. Well, if I mark my portfolio to market once a quarter, my volatility will be smooth as well. But we in public markets have to deal with that volatility on a day-to-day basis. And so we'll see some of those changes come through in updated quarterly reports. But I don't think it's a systematic risk that people need to worry about. The losses will come through. Maybe it's 10% loss on defaults, 70% recovery on that default. So you've got sufficient income to cover off in absolute terms.
So even if you had that situation, the funds in question probably would still be in positive territory on that basis. You
would assume so. Now the question is, what does that look relative to other investments that you can make, not just in absolute returns, because obviously you get 4 or 5% on cash today and 4 or 5% on the government bond market.
Okay. Thank you. Well, we'll turn to our final story. Now, if you're feeling the pinch at the pump at the supermarket, spare a thought for the prospective clients of Coutts Private Bank, which has increased the minimum amount of wealth you need to have from 1 million to £3 million. Vicky, this was your scoop.
This was my scoop, yeah.
Tell us what's going on.
So on Friday, someone kind of got in touch with me and said, oh, I hear Coutts have upped their minimum, their criteria to bank with them. So it was 1 million and now it's 3 million. So the people who are banking with Coutts are fine for if you have 1 million with them, you're all right, you're not going to be turfed out. It's new customers, and for those customers, say for example, if you've 2.5 million you are directed towards NatWest Premier Service. But as we know, NatWest, Coutts owner, bought Evelyn, which kind of caters towards sort of clients with maybe 200k sort of investable assets. Yeah.
So tell me a bit more about that. So Evelyn is a wealth manager in its own right.
Yes.
And there's something here about sort of appealing to that mass affluent market. Still pretty wealthy.
I mean, it kind of covers all their bases, doesn't it? I mean, they've got the high net worth, they've got the mass affluent, they've got their Premier Service, and they've got their retail bank. I mean,
and that was a recent acquisition.
That was a recent acquisition. I think it's yet to get regulatory approval. Am I right in saying that? It hasn't yet. It hasn't yet. But I'd say you would sort of think that if you are a Coutts, you know, if you wanted to be a Coutts customer, they'll probably direct you towards Evelyn. You would think.
I think in your story you wrote, like, they haven't changed this in 20 years, and of course inflation's gone up a long way.
Oh, stop, yeah.
So, you know, people's wealth has gone up and they want to target the high net worth.
Exactly.
Parts of
it's so funny as well because advisors on LinkedIn, advisors are sort of screenshotting the headline, you know, Coutts raises their minimum threshold to 3 million. You know, we're here, advice. You know, they're kind of trying to. Yes, exactly. Yeah. Actually, I was talking to a press officer who deals with an advice firm, and this advice firm rang the press officer and goes, "Can we do anything with this? Can we kind of make ourselves known to these people who are no longer kind of Coutts clients?"
I used to be in that privileged position. Well, look, I'll be on the phone to my private banker after this. But thanks very much, Guy. That's all we've got time for today. A massive thank you to our production team and to our guests, Victoria Bell, John Schaefer and Paul Flood. See you next week.